And I must mention, but not to be a conspiracy theorist, that for the past 17 years, we've seen some kind of spreading illness has held an effect on the market that created sell-offs and fear. In 2003, it was SARS that caused the market to lose 12.8%. Avian flu in 2004. MERS in 2012. Ebola in 2013 and 14 at 5.8%. And Zika in 2015 to 16 at 12.8%. All these dips had an effect on your savings investments, whether you were monitoring it or not. This means both your leisurely investment as well as your retirement savings are not safe in a market that can be affected by virtually anything: politics, war, and disease. Never was, never will, and in fact wasn't ever designed to be. What's worse, all that's needed is fear. Just the threat of these things can influence the market, even driving it to the point of a recession. If you ever looked at the floor of the New York Stock Exchange, every day is paranoia. What's selling? What's rising? What's losing value? What's the next commodity? That same craziness seen on the floor can be seen in the streets just from the idea of a pandemic. So yes, even paranoia from a virus can affect the market and your savings nest. Need proof? The week of March 8th to the 14th, 2020 saw the Dow drop 1,250 points, or 10% of the market at the time, in the same week, with the latter being the largest drop since October 19, 1987, dubbed Black Monday. When the Dow dropped 22.6%, the following week, on March 16th, it dropped again, 2,997.10 points, or 12.9%, the current largest recorded point drop. All this pre-quarantine as the coronavirus started to take root in the United States. These drops simply based on the virus that on March 16, 2020 had 168,019 reported cases globally, with 6,610 deaths, or 3.9% fertility rate. In mainland China, where it started, there were 80,860 cases and 3,213 deaths. Just the threat of a global epidemic like this has shown it can take the market into a nosedive. While everyone's focused on trying not to catch the virus, we're paying little attention to our nest egg, as it couldn't be any more vulnerable than now. You may even seen, heard, or been directly told this is the opportune time to buy. But is it really? True, buying low is the most sensible time to buy. But what if you already bought in? If you did it at a time like this, you're losing. Some have losses of more than a year's worth in gains. As this person who's already got skin in the game, does it make sense to put funds into something that you're already losing? You're experiencing a loss, regardless whether it's short or long term. It's still a loss. And if you're new and will be purchasing your first stocks, yeah, the price is cheaper than it was a few weeks, even months ago. And if when the market recovers, called a correction, but is never permanent, you will experience an increase in your initial investment. But if you let it stay, and when the next scheduled bear market run happens, you will see losses in those gains. This will continue throughout the nature of the relationship. It's a game, and most do not have the mental stamina to play. If you're considering investing in the stock market, I urge you first to do something as simple as studying the history of it. But no worries, this is an assignment-oriented book. I actually did the research for you. I did a 105-year historical analysis of the Dow Jones. Let me first break down the difference between the Dow and the New York Stock Exchange. Before these inventions, trade is as old as the human species, who took to barter goods and services. Because people perceive value differently for different things at different times, we trade and figure out our buys and sells in order to get the maximum value. Today, New York City serves as the core financial nerve center of the world, and New York Stock Exchange and the Dow are the biggest vehicles to use for trade. As mentioned, the New York Stock Exchange began in 1792 and was created with the Buttonwood Agreement, signed by 24 stockbrokers at present-day Wall Street. After tremendous growth between 1896 and 1901, and mergers with Archipelago and Euronext, the company has today morphed into New York Stock Exchange Euronext, the world's first transatlantic exchange. The Dow was created 90 years later in 1882 by three journalists, Charles Dow, Edward Jones, and Charles Bergstresser, and started out as a financial publication, one of them being the Wall Street Journal in 1889. The Dow serves as an inventory, and the New York Stock Exchange as the exchange platform where people come to buy and to sell. Whereas the Dow gives an indication of how the market is doing since it averages the top 30 blue chip stocks of the economy, the New York Stock Exchange is where all the trades for thousands of companies happen. The New York Stock Exchange specials in listing all kinds of stocks and has both floors as well as electronic trading. The Dow, on the other hand, lists the 30 top stocks of some of the biggest companies in the world. The Dow's earliest post was February 1915, with a market price of $1,423.26. It wasn't until November 1996 that it surpassed the $10,000 mark, and just recently, December 2019, it hit an all-time high of $28,738.21. Over the years, the Dow has had its ups and downs, literally. And although we've seen steady growth, the drops have been triggered by the usual suspects: war, depression, bank runs, planes crashing into towers, and yes, the threat and activation of pandemic viruses. In summation, and in my honest and African-centered opinion, this systemic legal money laundering bowl of slop is a sickness of which I feel it's best we do not partake. For this slop provides no financial nourishment, only panic, confusion, and the runs to the market to pull out funds. I've yet to meet or know anyone who has also met someone who's actually mastered this madness. Everyone has advice, but they are as accurate as the weatherman. And there's no accountable obligation if and when they're wrong. Because we've been duped to believe this is the vehicle where you grow wealth, many blindly invest, having no idea how this system, or assist them, works. How many folks have spoken to you proudly, almost to the point of bragging about having an investment portfolio? I've asked many who have stock, when do you intend to cash out? I mean, the reason to invest is to be able to use it, right? Most can't give you an answer. I then ask, do you know how your stock is performing right now? The sudden look of no hablo inglés can be seen scrolling across their forehead like the Dow Jones ticker. I then cap it off asking, how much do you project to make when it's all said and done? The usual following facial expression is, how to let Mbwebe know I don't have a clue without looking stupid. Please understand, I don't ask to belittle folks. I ask because I realize, like I was when I first participated in investing, we haven't a clue what we're doing. We just want in. And that's cool when you're young and feel you may not need it right now. But if you invest in anything and are first not aware of the history of the market, not just in who and how it was founded, but just as important, its historical performance, so you can gauge its potential future yield, you're setting yourself up for failure. And this failure could come when you're in need of funds the most.